Good afternoon, everybody, and welcome to this Refinitiv Battlefin webinar called 2020 Midpoint, Navigating Through COVID-19's Impact on Earnings Through Alt Data. We are just going to give it another couple of minutes to allow people to join, and we'll be kicking off very, very shortly. So good afternoon, everybody, and welcome from a very sunny Switzerland, and good morning to our presenters and guests joining us from across the pond. Thank you all for joining us, and welcome to our latest webinar in our monthly Refinitiv Quant webinar series. My name is Tamsin Williams, and I am responsible for business development of our Quant and Feeds business solutions in EMEA here at Refinitiv. I'm stepping in today for Austin Burkett as your host, and I am joined by three esteemed speakers: Ish Panda, Chief Strategy Officer from Battlefin Group; Jerome Martis, Director of Consumer Research at Refinitiv; and Adam Barron, Director of Big Data Quantitative Research at Refinitiv. So as we head towards the midpoint of 2020, what can only be described as an unconventional year, we wanted to check in on earnings season and discuss how alternative data can help to navigate the impact of COVID-19. So Ish Panda will talk us through alt data and discuss some of the trends that Battlefin are seeing, as well as provide us with some examples and use cases. Jerome will follow up with a deep dive into COVID-19's impact on retail earnings and consumer spending before handing over to Adam Barron, who will take us through some examples of co-mingling fundamental data with LinkUp Jobs Posting Data. So before I pass over to our first presenter, just a couple of quick housekeeping items. In your audience console, at the bottom of your screen, you will see multiple application widgets you can use. If you have any questions during the webinar, you can click on the Q&A widget on the left-hand side of your screen or at the bottom and submit your question. We will get to as many as we can during the Q&A session towards the end of the webinar. On the right-hand side of your screen, you will see a short survey, so please fill this in before you disconnect from the webinar. Should you wish to know more about our alternative data offering or any other Refinitiv data feeds, you have links at the bottom of your screen in the resources list, or you can email me directly by clicking on the email button. At the end of the presentation, we will also be following up with a recording of the webinar, as well as a copy of today's slides. So without further ado, I will pass it over to our first presenter, which is Ish Panda, Chief Strategy Officer at Battlefin Group. Over to you, Ish.
Thank you, Tamsin. Can you hear me okay?
Yes, we can, Ish. Coming through loud and clear.
Good, good. So not as sunny as you can see from my background, as it's in Switzerland. It's kind of overcast out here in New Jersey. But a great good morning and good afternoon to the folks in the audience. Thanks for taking the time and joining us today. I will be talking about alternate data, about some of the attributes that you can look for in alternate data, but I'm not looking to go through a detailed definition of alternate data. I expect that folks who are joining it are already familiar with alternate data. And then I will go through some of the use cases or insights that we have seen recently come through. So I'll talk about a few examples from past history about, hey, this is what we saw from alternate data, and this came out kind of in advance before the company came out with its earnings releases. And I'll pick one or two examples of companies that have upcoming earnings in a short while. And maybe then we'll switch to a Python notebook and cover some job-related data products and see if we can find something there. So that's a quick overview of stuff I'm going to run through. Now, a quick introduction to Battlefin. We are a startup. I hope you guys have heard about us. Refinitiv is a strategic partner and has helped us in getting the word out and talking about the products. So thanks, a big thanks to Refinitiv on that. So we are an all data platform. We make it easier for folks to discover, search, compare, test, and purchase data, right? So the problem with all data is it comes from all over the place, and we source it globally. But how do you find a particular use case that applies to you? How do you compare the multiple products that are out there to inform on your use case? So this is one centralized place where you can come in. There is this historical data that you can check out, test, get your hands dirty, and look at some of the assets we provide. We do a quality report where you can compare different products and find the one that suits you. And as you test and find the product you want, you can go ahead and purchase that product. And Adam Barron later in this webinar will talk you through some of the user interfaces that people can exercise to find the products. So the current slide kind of shows our process. We go out and find products. We qualify them. We set up standardized assets. We do quality reports. We enhance those products. And we also combine those products. So quick intro, now jumping into the attributes of all data. So what is all data? It is normally sourced from different public and proprietary maybe sources. It does not come from a company which you are looking at. It's not something like a fundamental data. It's not like, hey, here's my revenues, or here's what my business process is. These are my new clients. So it's not about that. It's alternate sources of data. Okay, I'm having some trouble with my slides. Tamsin, you can see it okay?
Yes, I can.
Okay, maybe it's just a rendering issue. Okay, looks good now. So the advantage with all data is it gives you timely insights. You could get traction of a company with its client base or new marketing campaigns midway through the quarter. You don't have to wait till the end of the quarter to get information on the success or maybe not success with a particular campaign. And you can, and it's not just company focused, it's also macro focused. It can also inform on multiple asset classes. It can give you information on fixed income. Hey, there are bonds out there, for the city of Detroit. What's happening in Detroit? How's the job hiring there? So it could give you some advanced information about the prospects on both companies and on a macro perspective. It can give you insights on commodities, on pricing power, how pricing has evolved and changed over time. But with all that good stuff, also there is something to watch out for and be careful about. Information tends to be fragmented. So you may get metro area job coverage for some of the major metro areas, but maybe not all. So you got to account for that. Maybe the job categories that are included is not exhaustive. Maybe they drop off the ones which where they don't see too much traction. So you got to adjust for it, but where it has information, it is timely, it's actionable, right? But to make it actionable, there are some adjustments that a researcher or a user needs to do. And we'll talk about a few examples from that perspective. And like I was talking about earlier, coverage is not deep enough. History is not deep enough. Coverage is not extensive at times. This has actually gotten better. When I first started dabbling with all data back in 2013 at a big, quant fund, history was in terms of months. Very few all data products had 2 years or 5 years of history. So we always had to put it on a back burner because we weren't sure about the quality and about the trends that we see. That has gotten better. From a coverage perspective, again, things have gotten better, but some of the newer products have very limited coverage. They may cover one or two companies, or they may cover one or two geographical areas, right? But what they cover, they have deep insights into. For example, we have a product that looks at how many dozers or equipment Caterpillar factories are putting out, or how many fuselages are coming out of Spirit Airlines and going to Boeing. So yes, it covers one particular company and one particular line of business for that company, but what it does cover is very accurate and precise and something you can act on. On this slide also, you see examples of different categories of all data. This is not a complete listing. This is what I could fit in this slide. There are other types of all data too. We keep coming across new types of data. A recent one that came across my desk was something to do about dams. I don't know if you followed the news last week. There was a dam that failed out in Michigan, and it flooded the downstream area. What I heard was no fatalities, but extensive damage to the surrounding towns. Dow Chemical had to shut down their manufacturing facility in that area and evacuate employees. So there's a data set that covers the safety, or rather the lack of safety, at different dams all across United States. And we have other data that gives you that information from a global perspective. So kind of different, right? And similarly, there's data on climate. Yes, you looked at weather data extensively, but what are the climate trends in particular metro area? How does that, is there global warming happening? How does that impact the local weather? How does that impact the businesses? So there's climate data that's coming on board. So lots of examples here. If you have questions about any of these categories, you can of course post it in the Q&A panel, and you can also reach out to me. My email address is ish@battlefin.com. So happy to hear from you all. Okay, let's move on. Last point. Yeah, so you would say, why would you actually use all data if the mapping is not perfect and it's not point in time, right? So yes, that's a problem with quite a bit of all data, not all. There are some all data providers that have kind of mastered the art of mapping it to companies, probably again with the help of rich data set from Refinitiv. But there are others who are still, I guess, are challenged by it. Point in time is a big issue. But the data is still actionable. Data is still rich. Even if it's not mapped properly, there's stuff that users can do on their own to actually segregate the stuff that's properly mapped very easily. And you can do that on the Battlefin platform, or devise their own techniques to kind of improve on the mapping, right, and make it more point in time. And if I get some time, I might actually cover an example on that too. Very good. Let's move on. So here's an example. This is something we looked at in late December with our data partner, Prosper Insights. They are a survey data company, very extensive panel set, and I found some really good use cases from their data. Actually, before I go in here, sorry about going to and fro, but I just wanted to cover one more point. So as you can see, there's a lot of different all data categories, and we got over 950, almost 1,000 data products on our platform for folks to check out and play with. Now, how do I pick a few and talk about it in this webinar? A very, very difficult task. Which ones? I'm not trying to play favorites, but which ones should I pick? So I just did coin tosses. I did eeny, meeny, miny, mo. That's how I selected a few products, and products that we had used in the past maybe. So I had some history about those products. So Bed Bath & Beyond, it's a big brick and mortar company, has a lot of stores in your malls and in strip malls. Most people would go there for their, linens and whatnot, for furniture and furnishings. So, their quarter did end in November 30th. So that was their Q4 quarter. And in December, what we saw was that there was stiff competition, not just from e-commerce, but other brick and mortar chains like Target and Walmart. And the yearly spending by Bed Bath & Beyond shopper was about 7% below the average spend for that category. So people were based on this data, we could tell that people were looking to spend more in that category in Q4 time period. But Bed Bath & shoppers were actually saying they're going to spend less. So not a good place for a firm to be in. And that's what was borne out by their earnings call. There was an earnings per share miss by about 40 cents. Big miss. And what they shared was the same store sales was down approximately about 8%, which kind of lined up with what we were seeing from this data that customers were looking to spend about 7% less. So spot on. Now, does this happen every time? No, does not. So you have to look for stuff that has clear trends. I'm using this one particular data set as an example, but the power of all data is when you can combine different products together. So you see a strong conviction from one product, and then you kind of check it against, hey, are there other products that either support that conviction or not? And you have to explain that out as you reason and explore your investment hypothesis. So this is Bed Bath & Beyond. We had shared this information, I think also with some of the CNBC folks. I don't remember the outcome right now, but this was back in early January or just before their earnings release. So good example. Now, so this is how you see from their price chart. This is, I think it was about $16 or so. I think you probably can't see it on the screen. It was about 16 and change before they came out with their earnings. And after they announced, it kind of dropped to about 13 and change. So roughly about 20% drop. And then it kind of bounced around a bit before collapsing. And probably the collapses for other reasons, I think more COVID related. So this is back in earlier this year. Now, we worked on another example, which was Starbucks, and I don't have it in my slides, but do want to quickly cover it. So what we saw for Starbucks was, its customers were spending less on coffee at Starbucks, but it seemed to be getting more traction with breakfast food. Anecdotally and also from transaction data, we saw people were spending, more on coffee in these boutique coffee shops and kind of moving away from Starbucks. So that's the data we were seeing from multiple places. But when Starbucks came in and announced in, I think, late January or early February or so, their earnings were actually nice, and the stock did actually take off for a bit before it collapsed for other reasons. Right, so you can't always get it 100% right, So smaller trends, you either have to get a really strong conviction from other sources, or you have to be able to reason it out. But on the flip side, as we were exploring Starbucks, we were looking at its competitors. So Dunkin' Donuts still seem to be doing really well with their coffee and with their breakfast foods, and which kind of got borne out by their results. Okay, so let's move on to the next example. So this is more from a commodity standpoint. Again, this is historical. So this is data from late March. And again, it shows there was a price war going on, and the major producers were pumping like crazy. So production is up, and at the same time, oil on sea, oil on tankers as storage had really gone up. It's over 1 billion barrels that was floating on these tankers, around that time or so. And of course, you guys all know, price kind of collapsed from about 60 bucks or so in early January to I think about 11 and change on April 21st or so. So I think this data goes up till the end of March also. Okay, so 2 historical examples. Now let's see. So I was looking at companies that are about to announce in the next day or two, so didn't find really big, interesting examples. Okay, sorry, I was trying to scroll down. I have to press the yellow button to go to the next screen. Okay, so here's an example. So this is VIP Shops. It's an apparel company out of China, they've had a history of beating their EPS estimates about 30 to 50% in the last 3 quarters. So based on a quarterly survey that's done out of China by, again, our data partners at Prosper, we saw a big increase in traction by the heavy hitters like Tmall and Taobao. Right. So if I would put the chart here, the scale would be all over the place, and VIP Shops would not even show up. But then I selected 2 companies which I thought were kind of close to each other and competitors, so which is Uniqlo and VIP Shops. Now I don't cover this this sector or this industry. I'm not a sector specialist. I just look at data because I find it interesting. So I picked these 2, and Jeroen probably will comment on whether this made sense or not later on. So it looks like, VIP Shops is kind of in a downward trend, but Uniqlo seems to have bounced off their lows. So and kept on taking market share. So is the change that significant? Maybe not for VIP Shops, but the trend is definitely on the way down, right? So, well, their estimates are down for this quarter. It's 11 cents, but we'll find out tomorrow how they did. So I strongly encourage all of you guys who are listening in to also check out their earnings tomorrow. I will be checking it out too and seeing what we find. Okay, very good. Now let's move on. There's a polling question. So looking for some more information for you guys to share with us. Okay, so the question is, how much are you planning on spending in the next few months on sports goods? Right, so we were going through a lockdown phase, in the past few months. Maybe you guys were buying those sporting goods, home gyms and whatnot, and exercising at home. And maybe now you're looking to get out and about and participating in other activities. So just trying to get a feel for, are you planning on spending on sports goods? These could be sports apparel. It could be, a tennis racket. It could be like a bike and things like that. So what do you guys think? Please respond. Very interested and curious in seeing what the audience sees this as. And then I'll cover a sporting goods company that's also going to come up with an earnings release tomorrow. Okay, let's give it another 30 seconds or so. Let me see if I can respond to it. Don't want to bias it, but do want to check it out. Adam, Jaron, and Tamsin, I want you to respond too.
I don't believe that we can, Ish, on the basis that we're looking at it as a presenter's view, but maybe we should move along a little bit and see the results now. Okay,
very good. Wow, evenly split. Okay, so let's move on. Let's look at this example of Big Five sporting good that's coming out with an earnings release tomorrow. So it's a company that was doing really well, but started struggling since about summer of 2018. We do see seasonal bounces happening early in the year. People come up with their New Year resolutions and get out and about. So the estimates is about a negative, 20 cents or so for this quarter. We do see a big drop in spending score. So people generally were spending a lot less. It kind of collapsed from about 75 points or so to about 42 points or so in the last few months. But then we see a rebound, and that rebound is more recent. We'll see if it has an impact on their earnings or not. So stay tuned on that. Though we do see them taking a little bit of market share from other stores. So hopefully there's some positive news on this one. Okay, I'm getting a time check, so I'll try to kind of go a little faster. Again, what are some of the trends we see? So we look at these trends across multiple products, but it's difficult to kind of collapse all of that in one slide. So I said, okay, let me just look at trends from one of our data products. So, we saw a big explosion in online, grocery delivery. We saw a big explosion in traction, like 4,000% or so in web conferencing later on. So all of that has started to kind of plateau based on recent web traffic data. It's reached its height. It's kind of, the growth rate has kind of steadied or started to deaccelerate a little bit in different places. But there are clear trends that we see here. Website builders, Shopify, all seem to be doing good. And more companies are moving to an online presence. And jobs data also, employer traffic seems to be going up. People are starting to post new jobs, which I think Adam will also cover later during his session. But are job seekers getting out there or not? Not really. Maybe at least in the U.S. there are unemployment benefits and PPP programs that are kind of driving this trend. We'll see more over the next month or so. Okay, next poll. Let's see. Okay, let's be really quick on this one. Please do respond. So which job category do you think has been the most resilient, where the impact has been the least? Right? Please quickly submit your answers. Right, and let's see what we see. Oops. Oh, sorry, I didn't get any responses maybe. Or maybe let's see. Now response is coming through. Thank you. Thank you for participating. So grocery delivery, transportation, logistics, security, people think not as much. So it was actually all of these three job categories were doing very well. So sorry about the trick question. Grocery delivery is actually kind of starting to hurt because they can't find enough employees, and because there are now lags built up into in the delivery timelines. So people have started kind of getting off grocery deliveries and moving more to wholesale retailers, going out or ordering food directly for delivery. So all of these three sectors are doing well. Security has actually been a big standout. All these places that closed down now need security people to keep an eye on them. So security from a job perspective has done really, really well. Okay. If it's okay, Tamsin, I'll take a minute to just go through this and I'll wrap up. And if we have time later on, maybe I can come back to the Python notebook or so.
Yes, of course.
Okay, thank you. So trends from job posting. So this is from our recently onboarded product from South Bay Research. What's happening at a macro level? We do see some rebound in job postings, and we think that kind of drives the employment too. And the job postings have recovered to about 80% or so level for metro areas that have been about 6 weeks or so outside their lockdown. And like we discussed earlier, security seems to be the most secure job category at the moment. And surprisingly, I said about point one, surprisingly, rebound seems to be kind of leveling off in Florida that exited lockdown 3 weeks back. I think this is more to do with, hey, are there new cases coming in? Is there maybe, people are still off and don't feel safe enough to go back. So we'll see how this evolves in the next, month or so. And the other interesting thing that we found from the last week's data was internet companies, Google, Facebook, eBay, their job postings has kind of fallen off the cliff. So what's going on out there? Maybe because advertising dollars spent kind of fell off. So is that what's driving these companies to take a step back? So stay tuned as we analyze this data. Maybe we'll cover this and post it in a blog post or do something. And if I have time, I'll come back and cover this in a Python notebook exploration kit. So of all the products that we have on Battlefin, we have quite a few that has exploration kits, which are starter Python notebooks for people to, start playing with data. And I have a trading strategy based on social data too, which I'll cover if we have time. So I think I'm at the end of my session. So people who are interested in all data, please do check us out at Battlefin Ensemble. Create an account for yourself or reach out to me and I'll help you, explore data on our platform. I think that's it from me. Thank you. And Tamsin, over to you.
And we can go directly over to Jerome.
Good morning. My name is Sharon Martis, and I am the Director of Consumer Research at Refinitiv. And today I will be talking about COVID's impact on retail earnings. I'm going to start off discussing a little bit about the new reality consumers and retailers are facing. Retailers are also reporting earnings as we speak. So we're going to talk a little bit about the winners and losers. And in strange times like this, we're going to talk about how powerful alternative data can be when you combine it with fundamental data. And of course, we'll talk about the changes that we're seeing in consumer spending and behavior and preferences, and what this all means when we reopen the economy. So without further ado, let's get started. So as you can imagine, the consumer sentiment took a deep dive, a nosedive when the coronavirus pandemic started. Consumers currently are starting to feel very, very much concerned about the future wave, a possibility of a second wave of the virus. And they are also very much concerned about their own employment. The unemployment just hit a record high. And at this point in time, consumers all have a family or a family or relative that has lost their job. So for those millions of consumers that have lost their job, they're being very, very picky right now about only purchasing key essentials and necessities. Whereas those that are employed are in fear of losing their jobs in the future and are currently putting their hands in their pocket and holding back on spending. And this is definitely being reflected in our same-store sales data, which reflects retail sales. Millions of stores around the world have been forced to shut down during the pandemic. And as a result, in the United States, the same-store sales index is expected to be negative. This is the weakest showing we've seen since the greatest recession in 2007 and in 2008. And as you know, consumer spending in the United States makes about 2/3 of the U.S. economy. So that's why it's important to keep a close look on the same-store sales data, because it has such a big effect on the economy. Now, having said that, as I mentioned, big retail names like Walmart and Target, Home Depot have all reported last week, and the rest are still going to report next week. So let's talk about a little bit of what's happened and what are the expectations going forward. As of right now, 74% of retailers have reported earnings. And as you can see on the chart on the left, 9 out of the 11 sectors are expected to post negative earnings. In fact, they're expected to post negative double-digit, and for the multi-line, triple-digit are expected to decline significantly. The multi-line retail is expected to decline the most, and this is mainly because of the department stores is bringing that sector down. The department stores had been struggling for some time, even before the coronavirus, and therefore have been the most vulnerable during this period. On the other side, there's 3 sectors that are expected to see positive earnings growth, and that is the household durables, household products, and even food and staples, which are benefiting from the fact that they're selling key essentials, but also from the fact that they've invested for a very long time in a very strong omni-channel experience strategy that today is helping them weather the storm better than others during the coronavirus pandemic. So in strange times like these, we're seeing that retailers are withdrawing their guidance. They're not telling us much about what to expect from them. We're also seeing that over 50% of the companies are expected to post negative same-store sales because their stores are closed. So how do you get a good pulse of what's going on in the retail sector and the consumers? And this is where combining alternative data with fundamental data can be very powerful. Refinitiv, in a collaboration between Refinitiv and Battlefin, we were able to get some interesting employment data from LinkUp Data, which tracks global jobs around the globe. And it allows us to see if there's a surge in layoffs and hiring freezes around the globe, and therefore then determine, the direction of earnings. So let's look at this example of Best Buy. Best Buy reported earnings last week. And if you look on the chart on the left, you can see the green line reflects current job postings for Best Buy. The purple line reflects our consensus for revenue. And then the yellow line reflects our smart estimate for Best Buy for revenue. And for those who don't know, the StarMine Smart Estimate is a weighted average of analyst estimates and puts more weight on the analysts that are more accurate and the latest earnings or revenue estimates. And our study shows that when this smart estimate differs from the consensus by 2% or higher, it is significant in telling us the direction of whether a company is likely to beat revenue and post positive surprises or not. So in the case of Best Buy, you can see that towards the end of February, the consensus dropped. And then, of course, the job postings by Best Buy also followed and took a deep dive, telling us that the smart estimate was ahead of the herd. But then what's interesting is that on May 17, you can see the yellow line actually spiked, and telling us that the smart estimate is suggesting that the company might actually beat on revenue estimates and post a positive surprise, which was actually the case for Best Buy. Last week, they beat consensus estimates for revenue and posted a positive surprise. Now, this company posted an impressive 154.4% growth in e-commerce. And they did that while closing all of their stores and only allowing consumers to do curbside pickup. So what this means is that they were able to post an impressive e-commerce numbers without allowing any consumer to actually set foot into their store. So this underlines why it's so important to have a very strong omni-channel experience. And, this is reflected today in our StarMine models, especially in the analyst revisions models, which tells us that if you can see on this graph in the table below, that Best Buy scores a 94 out of a possible 100, suggesting that analysts are very likely to revise revenue estimates upwards for Best Buy because of all of the everything they're doing during the coronavirus. They have a very strong omni-channel presence. The retailer has been very strict about reopening its stores. Just now they started reopening again, but they've been very strict. They have very strict policies in place in order to how they're allowing consumers to come back into the store. For starters, you have to go onto their app. You have to request an appointment. Then you get a call from a customer representative who then does a screening and asks you a couple of questions. And once you pass that screening, an appointment is scheduled where you are escorted by a customer representative by wearing a mask and following social distancing guidelines into the store. So as you can see, analysts are very bullish on this company going forward. So, as I mentioned, retailers have been reporting retail earnings, and they have given us some clues about how COVID-19 has changed consumer spending behavior and preferences. There's actually four main themes. There's four main principal themes that we're seeing across the board, and that is, of course, social distancing. Consumers are making significantly fewer trips to the store, but are purchasing more when they decide to do the curbside pickup or go to the store. And as a result, because they're forced to shop online, we're seeing, like, for example, Walmart e-commerce sales grew by 74%. But this is coming at a very hefty price. So what we're seeing is that, consumers are sticking to mainly key essentials, and they're not really buying discretionary items. So they're not paying really full price for things like apparel, things that they feel like they don't need because they're not going to the office and they're staying at home. So as a result, then we're seeing that the retailers are having huge expenses because they're hiring new employees, cleaning up the stores, extra hours for the cleaning, and they're not even allowing many consumers to come into the store. So all that is affecting their expenses. So yes, Walmart posted an impressive same-store sale. They knocked it out of the park, beat analyst estimates, and came in at over 10%. E-commerce, 74%. These are very high numbers, but profits did take a hit because they're seeing huge expenses. So these companies have been winners. There's been a lot of talk that the reason that they're winners is because they're mainly selling key essentials. But it's important to note that it's not just because they're selling key essential. These companies have also invested significantly into the omni-channel experience. Take Target, for example. Target, for the last 5 years, they were beating their earnings estimates, but their stock used to plummet after they beat these estimates, because they used to say during their earnings call, we are investing heavily in our omni-channel experience. But that is paying off today. Even for the European luxury retailer, Louis Vuitton, LVMH. LVMH is telling us that it's Christian Dior, Louis Vuitton, and stores have been able to weather the storm much better because of their strong e-commerce. Despite the closures that they have in China and Europe, their e-commerce is what actually helped them stay afloat. Home Depot posted digital sales of 80%, and they're telling us that this is mainly because over 60% of the orders were for curbside pickup. So never has it been more clear that strong omni-channel presence is key for these retailers. And Walmart also telling us that this is attracting new customers, and this has been growing fourfold since mid-March. In the around the world, the amount of money that consumers spend online has been growing significantly. But yet, in the United States, believe it or not, e-commerce sales only makes up for roughly about 10% of total retail spending. So the amount of money that grows has been growing significantly, but still this brick and mortar makes up the bulk, like almost nearly 90% of total spending. So, and this is also because there's been some groups of people, of customers that have actually been skeptical about actually entering their credit card and online or on a mobile device and purchase. They've been, they don't feel too secure about it. So, and this includes 65 and older, which we know is also the most vulnerable generation when it comes to COVID-19. So what's happening right now is this group of people is forced to stay at home. And if they want to get groceries, they are forced to go online and have these delivered to their houses. So for the first time, a lot of these people that have been withholding on this are actually experiencing online delivery. They are getting a taste and they are actually satisfied because it's actually doing what it's supposed to do. They're happy with the service, that the products that they need are being delivered to their house without compromising their health and leaving their household. And therefore, this can create customer loyalty. And this is a permanent trend that we're expected to continue to see going forward. As I mentioned, the amount of money consumers spend online has been growing for the most part, but now we can actually see it growing significantly more with these numbers. Walmart telling us that e-commerce is growing 74%. Louis Vuitton telling us it's growing significantly. Home Depot telling us by 80%, Target 80%. So those companies with a very strong omni-channel, which allows the consumer to shop seamlessly, are expected to be the biggest winners also during the coronavirus pandemic. And another trend that we're seeing is that because consumers are at home, they're improving the stay-at-home experience, and they're doing a lot of the things themselves at home. They're asked to be teachers. They're buying fabric to make their own masks. And Home Depot are telling us that they are repairing their homes or improving their household in different ways. And this also helped Home Depot continue to see strong sales during this retail earnings season. So a lot of countries have now reopened their economy. And in the United States, a lot of retailers like Macy's are pushing in order to reopen their stores across the United States, especially because they're seeing a liquidity crisis, a cash problem, because they've been hurting for so much time before the coronavirus. And now with the coronavirus and having their stores closed, we mentioned that they have been the most vulnerable right now during this pandemic. So for that, we turn into our consumer confidence report to see how consumers are feeling about the reopening of the economy. So I wanted to take a quick pause and ask you, how are you guys feeling about the reopening of the economy? When, if ever, do you expect to attend or go to do the following? For example, when do you expect to go back to a shopping mall? Are you ready to go to a shopping mall now, whenever Macy's decides to reopen to the public? Or do you feel more comfortable going when there's a coronavirus vaccine, even if that means you would have to wait a year from now? Or do you feel comfortable never going back to the shopping mall, or you just don't know? Please take a quick second, think about it, and let us know what your answer is. Interesting to see.
This is definitely a great question, Jerona, especially, for example, here in Switzerland, where we have already started to reopen the shop. So good to see what our audience think on this one.
And how is traffic in Switzerland now that it has reopened?
Surprisingly, it's starting to return to normal levels. It's quite frightening, the adjustment. The biggest thing that you see is the social distancing we take on the sidewalks, for example.
Yes, it's interesting because Nike is now on the other side. They closed many of their stores in Asia during the pandemic. And so they were able to give us a little glimpse of what the future might look like. And they're telling us that now that they've reopened, mall traffic is starting to be back at the levels that they saw pre-coronavirus pandemic. But even though the shoppers are coming into the stores, they're looking at the merchandise, but then still going online to finalize that purchase. So again, why it underlines that a strong omni-channel is key for these retailers. So now let's take a look at what your answers are. And it looks like there is a big divide that some people are ready to go to the store now, and the other viewers are willing and able to wait for a year once there's a coronavirus vaccine. And 8.3% don't want to go back, and 10% don't know. So as I mentioned, we did this survey during our consumer confidence report that we do in combination with Ipsos. And here is what consumers are telling us. They are telling us that the bulk of them don't want to return to the mall or a theater unless there's a proven vaccine, even if that means a year from now, which is kind of what you guys said. So only 35% want to return to the mall, 41% want to return to a live concert once there is a vaccine, even if that means it's a year from now. And when the economy reopens, they're telling us that live concerts and performances should not reopen to the public before a vaccine is available. Over half of consumers feel this way. So this is telling us that at least for in the United States, we might not see huge crowds returning to these venues initially until consumers start feeling more and more secure about their health and wellness, which has been forefront on consumers' mind. Ish mentioned earlier that because of health and wellness, a lot of consumers have been buying workout merchandise, and that is the one item we found that consumers are willing to pay full price for in a time when they're being frugal with their money. But without further ado, I'm going to pass it on to my colleague, Adam, who's going to talk more about how we use LinkUp data and alternative data and how it's very powerful when you combine it with fundamental data. And later in the end, I'm happy to take some questions from you.
Great. So good afternoon, good morning, especially good early morning to those of you in California like myself, where we started this at 6 a.m. After a long holiday weekend. So I'm actually on that StarMine research team that Jerome mentioned. StarMine's been around since the late 90s. We have many more models besides smart estimates and analyst revisions, covering many factors. Over the years, some really interesting machine learning stuff, like using text mining to predict the probability of default of a company within the next year based on what's said in the news and broker research. In my particular role, as of late, I've been focused on alternative data. We're often considered at the company like an internal quant customer because we use Refinitiv data, just like our, quant customer hedge funds do. And we're also keen on alternative data as well, because we see the potential about using that in our next generation of models. So this Battlefin partnership collaboration that we have has been quite beneficial from my own stance about contributing to my research efforts. So I will just jump right into a demo here. So for those of you, some of you may have been on the Battlefin website before, and some of you may not. This is the product catalog. There's 955 products, so that is a lot of alternative data that you can explore. It's worth noting that there's 94 that are specifically tagged as related to COVID-19, but if you just browse through, you see many can be quite applicable. Refinitiv, our own data, has a pretty big presence here. There's a lot of traditional data like data stream pricing, the IBIS estimates that Drone highlighted, and some stuff that we'd call alternative data as well, like machine readable news, with sentiment on the news. And then, of course, StarMine gets a shout out here too. But what's really interesting, though, really relevant, is this thing called the on sandbox. So I was going to do a polling question, but for expediency, I'm going to skip it. But the general gist was, how long does it take to try alternative data once you've decided that you want to use it. And prior to this Battlefin collaboration, for me, the answer was it was a long time, because you had to have several calls with the alt data vendor. You had to get your legal team involved. You have your default contracts. Maybe they accept it, maybe they don't. Your lawyers go back and forth. Then you finally agree to terms. Then eventually you have to get the data from some random FTP site or an S3 bucket. Anyway, it was long. And the great thing about this on sandbox tag is that this is data that once you sign your master agreement for Battlefin, you can start using immediately. So LinkUp is what Jerome mentioned that I'm going to dive into a little deeper to pair it with Refinitiv data. But to try out, this data, there's this button called Access on Ensemble Now. And I've already got access because I've been analyzing it. But that's how easy it is to give some alternative data a spin. Obviously it's a sample. Many cases it will be time delayed. But it's something you can get your hands on to get a feel for beyond just the marketing material. So, when you click on this thing called Sandbox, you get brought into the Sandbox, which is essentially like a Jupyter notebook, a little bit locked down to comply with the restrictions about this is sample data. You're not supposed to be, taking off on your own and copying it or anything like that. But it still functions a lot like Ensemble with many of the great Pythons you like. With many of the great Python functions that you're used to using. So this example is going to go through Best Buy, how that chart that Jerome showed, how I created it. So like I said before, you can pull in any Python library that you really like using. The main magic for getting the Battlefin data happens with this Battlefin library. And when you say get data, when you do the get data sets, you can see all the content sets that you're permissioned to. So here we're going to be using IBES data, but you'll also see that for LinkUp, there's also a good amount. We're going to be using the core ticker analytics. And, just for this one example, I'm going to focus on Best Buy, but I should note that in my day job, I've looked at LinkUp and Refinitiv data, IBES, smart estimates for quite some time. Generally speaking, we see a strong relationship between large job posting adjustments and then similar analyst movements. These sell-side analysts that are represented by IBES, their full-time job is covering a small set of companies. They know these companies very well. And in these times where, as Jerome mentioned, the companies are being very cagey about giving much guidance, and in some cases, at least in the US, because of SEC, they're allowed to report earnings even later than usual. We really rely on these humans. But the sell-side analysts, they don't necessarily have access to all these alternative data sources. So there's a nice interplay about looking at the two in combination. And one thing that we've seen at StarMine since the beginning of StarMine in the 90s was that analyst revisions move markets. People pay attention to these experts, and when their view changes, often the price will change either immediately in response to their view change, or a little bit later on, a little bit later on down the line. But basically, it's really important to. The point is to not look at alternative data in isolation with just price and returns, but to also see how the analysts feel. And the real sweet spot we see is when there's a movement in alternative data that has not yet caught up in the analyst community, because it often means that the analysts will revise. So turkey in the oven and out comes a cooked turkey. So this is the cooked turkey. It's an example that shows exactly what a lot of my research has brought us to on a greater trend. So anyway, with the simple command, if the data is of a reasonable size, you can do the Battlefin get and grab your content set, and it puts into a pandas data frame. The LinkUp data looks like this. It's a time series of by day, by ticker, and this created and deleted job counts there on a daily basis. On that given day, what jobs were posted, what jobs were removed from their own company website. And then unique active jobs is what we actually use more. That's a daily snapshot, which, in a sense, created and deleted aren't cumulative, but active jobs it is cumulative in the sense that every created job and deleted job is encapsulated in that daily number, and that's what we mainly use. So for IBES, we have a lot of data. Multiple analysts covering multiple companies, and they're not just projecting earnings, forecasting earnings for this coming quarter, they're forecasting for many quarters out. So there's a lot of data. This is actually too big for to pull it all at once in ensemble. And this is just a snapshot, like maybe a 2-year history. So we have a lot of data. We have a lot more in our Refinitiv products like QA Direct, but even what we have in Battlefin is quite a generous sample set. So to get a reasonable amount of data into a Pandas data frame that can fit into this, we can do some server-side filtering. So whereas I grabbed all the LinkUp data at once for just the daily time series of job postings, for IBES, we're pulling for a single single company. We're going to pull the revenue for a single period, and this is what the data looks like. I used estimate ID, but we have ticker, we have these org instrument quote perm ID. So I highly recommend you at some point you check out permid.org. It's an open source Refinitiv identifier, meaning no license fees. But there's many, basically, the main point is there's many ways that we can pull up data for these companies. And then the thing we're actually going to pay attention to is this consensus estimates. That's the equal weighted estimates of what the analysts feel the earnings will be for a given period. And if we look at effective dates, we'll see that it's actually intraday. So whenever an analyst changes his or her estimates, a new consensus is put out there. And because I just want to do a simple charting, I'm actually going to collapse this into the last estimate on a given day. We could do intraday charting, but the LinkUp data is just daily charting. So this is a quick hack, but know that with IBES, we have much more granular time-sensitive data. So then bunch of, Python magic here, but this is the plot that Jerome showed. And I mean, that's how we got to it. So once again, I just want to highlight that towards the end of March is when Best Buy started revising down. And it wasn't until April that the analysts really in force started revising down as well. So the point I want to focus on here is just, predicting the analyst trends, that, there was a pretty good lead time about Best Buy taking an action. And, these action, with COVID, it's pretty obvious that, all these retailers are worried about foot traffic, but many times, thing with all the job postings is that the company is aware of something, that they're preparing for in the future. And the analysts may have not picked up on that yet. And whether the analysts pay attention to job postings or not, I really don't know. But the analysts eventually learn whatever the company was anticipating. So that's the relationship that knowledge happened in this gap. So it's important to anticipate it. And another example that I'm not going to go through the code again is Farfetch. So once again, they too, actually pretty early on in the COVID crisis in mid-January, they started pulling jobs. And it took a while for the analysts to revise their estimates down. But something really interesting happened at the end of March is that they posted a bunch of jobs, and there has been a slight decline, so maybe by 50, but that could have been that they filled the jobs, yet the analysts haven't quite revised their estimates yet. So that's something to watch for when you see a big trend in the opposite direction that analysts haven't quite incorporated yet. I mean, there has been a little bit of revisions come back, but not much. And then LVMH. So in this case, it was actually the opposite, where the analysts revised the revenue estimates down before they pulled, the jobs from the website. But I think, two things I want to highlight here. As Ish said, not every example is going to show you exactly the leading trend you want to see. But, the factor that we've been exploring at StarMine is really when there's a strong change percentage in a certain direction, and the analysts have not also moved in that direction in a set period of time. So in this case, if we were to create such a factor where we're looking at the, directional changes, this wouldn't even register because we would have been like, okay, the analysts have already revised down recently, and this wouldn't trigger to it. So you have, once again, you have to look at the alternative data and along with what the analysts have done recently to see if there's any new information that the company may be signaling with their job changes. In this case, because it came, similarly after the analysts revised, not something we should really be paying attention to. So that, I think, is a good place for me to pass this back to Tamsin to wrap up. So that's because I think I covered some good charts that I wanted to get through, and so thank you.
Thank you very much, Ish, Sharon, and Adam, for joining us and for your insightful presentations. We've kind of run over right now, which means that we haven't had time for the Q&A sessions. But what we will do is we will circulate all of your questions amongst the presenters, and we will get responses for you, which we will send out when we send out the presentation and the recording of the webinar. So just to say, this is part one of a two-part alternative data webinar series. No doubt we will invite Adam back next month to go into a bit more detail, as I'm conscious that you were kind of a little bit rushed through there. So please watch out for that. You will get full details sent to everybody that's currently on this webinar in the coming days. This concludes our webinar, so thank you everybody for joining. Refinitiv wishes you a great week, and please everybody stay safe. Thank you very much.